Hi, everybody. Really sorry for the delay getting started. That was, in fact, my fault. So we can blame me for that. Because we're already a few minutes over time, we're going to get started maybe faster than usual, but it wouldn't be a CFO Connect webinar if we didn't at least ask you to introduce yourselves, let us know where you are, maybe, let's say, where you are in the world and what you're doing, what your role is in the company, just so we know who we're talking to. So I'm Patrick. I'm in the marketing team at Spendesk, which is why it says Spendesk team. But of course, I am heavily involved in content at CFO Connect. I'm going to introduce both of those things just for anybody who doesn't know what Spendesk or CFO Connect are in a moment. I'm also going to introduce our special guest shortly, and I promise you I will be doing very little talking if everything goes well, which it will. Already got we've already got a few hellos from Serge, from Christo, from Saeed. Let us know where you are in the world. Melanie's in San Francisco. Hi, Melanie. Florian. If you want to let us know as well, I'm going to assume that most people are at least in the finance team and probably a lot of CFOs. If that's not you, definitely let us know. So that we know who we're talking to. We've got Anna, who's a finance manager in Berlin. We've got Christo in Montenegro, John in NYC. Welcome. Lucy in Paris. Welcome, welcome.
Hey,
Pierre-Louis wants to say hi to Younès. Bernard. Holzkirchen. Ooh,
Holzkirchen.
Holzkirchen, thank you.
I think from my German speaking days.
Next to Munich. Okay, I know Munich. Well, welcome. Vladimir in Paris, welcome. Erwan in Paris. Cool. So we've got lots of France in Paris, as I think we can expect, because Younès, you and I are both in Paris. You're in Paris, right?
I'm in Paris, yes. I'm in Paris.
Cool. Yeah. Cool. But it's also good to see that we have people in the US. We've got people in Germany, Austria, hopefully some around the rest of the world. Okay. I'm going to get started now because I've already kept you all waiting long enough. I have a few slides, nothing daunting, very few words to read, so don't worry, and then we'll get into it for real. So, of course, you all know, hopefully, that this is a CFO Connect AMA. CFO Connect is the go-to community and resource hub for finance leaders in fast-growing companies. And as we've already discovered, most of the people who have shared their job titles with us are in finance. So that's fantastic. CFO Connect is, of course, powered by Spendesk. For those who are not aware, Spendesk, we're really the go-to spend management solution, which really means that we put together expense reports, company credit cards. As you can see in the picture, we give you nice, smart Visa or MasterCards, depending on where you are in the world, but also things like subscription management, invoice processing, automated accounting. So the whole idea is just to take all those really tedious, repetitive things that you often have to do at the end of the month or the end of the year and try to automate them as much as possible. That's enough of that. Today's session is going to be great. I am quite certain. We're having an AMA with Younès from the family, who I'm going to let introduce himself properly in just a moment. I promise I'll stop talking. Really, there's not much on the agenda. We're going to talk with Younès, and there's going to be a Q&A. That's it. I'll ask a few questions at the beginning, but really what we would like most is if all of you in the audience also contribute your questions, because they're probably going to be more interesting, frankly. Final thing, you must check out CFO Yeah, the podcast. If all goes well, and I think it will, this session will become a podcast, in a couple of months when we've had time
I'm just learning that.
No.
Sounds great.
we discussed that, but maybe I forgot to remind you. We've done one podcast like this before. Otherwise, we have lots of great conversations with CFOs from companies you've heard of, like Notion, Zapier, SoundCloud recently. We just had a really cool one with a company named Permutive. So please check it out. Those are all the slides. I'm now going to stop sharing my screen and we're just going to have a conversation. And where I would like to begin is, I hope not a tricky question. Why did the family need a CFO?
Oh, that's a great one. But first of all, thank you, Patrick, for having me. Thank you to everyone at CFO Connect. And thanks everyone for joining us. I see we have a global crowd. So I'm sure this discussion will be very, very interesting. Why did the family need a CFO? That's an interesting question because for those of you that do not know what the family is and what we do, if you check on our website, thefamily.co, our logo is a phoenix. So it has had multiple lives throughout the years. The family was founded in 2013, but I guess where we stand now, the latest iteration, is a global kind of accelerator that aims to be the first yes in the life journey of many startups. And we try and take the entrepreneurs from the earliest possible stage, meaning usually just a bunch of founders and a cool product, to them raising their first round of institutional money from venture capitalists. So come back to your question. We do have people in the team who know how to raise funds, who know a lot about financials, and we're an investment company. So we have a bunch of financiers within the team. But the interesting thing is that in France, we have this saying, which is les cordonniers sont les plus mal chaussés. I don't know if you have a spot translation for this one. Usually, what you do in your work, you will be less good at yourself. And the infrastructure finance, in finance infrastructure, yeah, shoemakers go usually barefoot. That's a good translation. The finance infrastructure at the family was subpar, which was kind of weird because we're a financial institution, and at some point we needed to start developing a lot of specific bricks that required the attention of a CFO, just like it's the case in many startups. When you start raising institutional money and you have investors come in, then that's usually the moment when you would start needing to structure a finance team and maybe have a CFO join. That's the moment when it becomes important, and it was about this time in the life cycle of the family that a CFO was needed. And having been with the organization for many years, actually since 2015, this is quite a long part of the family's journey itself. I was offered the opportunity, and I thought it was really exciting. So that's why I took it.
What were you doing before at the company?
So I did multiple things. The first thing that I did was deal flow. So I was basically screening startup companies, meeting with a lot of entrepreneurs. I was based in London at the time. Meeting with entrepreneurs and just basically getting familiar with the issues that you can face just being an early stage entrepreneur. Some I did know about, some had really no idea that they actually came up. And as you went through doing the deal flow, you start creating relationship with the founders, because that's what we do. I mean, the name The Family isn't just out of the blue. It's because we try and give a sense of community to the founders, and we try and give what an actual family provides, which is support no matter what, education, access to financing, these kind of things that you will find in your actual family, well, you can expect from us as a founder. And so as my relations with some investee companies grew, I started discovering what the various issues were for companies, startup companies, like hiring, fundraising, developing the strategy, sales, product development, all of these kinds of things. And at some point, I decided that my expertise would be around building finance operations, because that's too often overlooked. And I started helping the founders around this specific issue.
And then that sort of led naturally to you becoming the CFO of the family itself.
Kind of naturally, yeah, because in between, I went into one of our startup companies that's doing education. And so we were a novel kind of training organization where we wanted to train startup employees because there's a lot of content out there that's dedicated to the founders themselves, which is important because entrepreneurs have a lot of things to learn, especially when it's the first time that they are building their companies. But very often there's a missing link, and the missing link is that nothing is targeted towards the employees themselves. And so we wanted to build a training organization for that. That's something kind of similar to what On Deck is doing these days, and they're really great at. And so I stayed there for about a year because I had never had an entrepreneurial experience myself, and I felt it was important for me to do that before I actually had the opportunity to become a CFO. So that's how things kind of looked and structured. If you look at my resume, it's kind of weird. There's like a year and a half of joining an education/training organization, but I really enjoyed doing that because I also enjoyed making content and sharing whatever I learned.
And so sort of concretely, what were the expectations of you when you took the role?
I guess I could answer under two aspects. No expectations at all, because the co-founders of the family are kind of weird in that sense, is that they are really great at sensing, let's say, weak signals, and they pick up on things that other people usually do not pick up on, which is a reason why the family has so many counterintuitive startups in its portfolio. It's because we like to see in some people what the rest of the world doesn't see, or what the rest of the world do not see yet, and they just create, the spark that may have it become something. So they sensed that I might be great in this role, and they just said, okay, just go ahead, try it out, and we'll see how it goes. So very low expectations. And then again, from my own perspective, I kind of had like a really scattered / cluttered roadmap, because for all the past work that had been done within the family in terms of cash management, accounting, structuration, etc., there was no coherent, cohesive process. Not a lot of processes in place, actually, because different team members, different times, everything a bit scrappy. That's how it used to be. So my main perspective was that, okay, how do I structure this thing so that it becomes the financial powerhouse that we want it to be? Because on the front end of the family is us helping the entrepreneurs and being with the entrepreneurs. On the back end, we're an investment company, and in order to grow, we need to have good people, good processes, and good tools to help us do that.
Mm-hmm. And what were you confident about stepping into the role? Like, what did you know or feel strongly that you would be great at right away?
So my initial background is in finance. So I have a couple of master's degree in business with specializations in finance, but mostly in market finance or investment banking. And I've held very short time positions in private equity. So I know this world kind of, and I know that this gives you strength stepping into the role on things like valuation, understanding financing, understanding what the investing world is about. So I knew that those were the things that I would be great at. And there were things that I just kind of remembered from either being a business student or from having an entrepreneurial experience, like okay, accounting is a pain, but I still have to take care of that, or payroll, for instance. And then there were things that I had no clue would come up. I guess number one on that list is coronavirus. Facing a crisis is a serious headwind that you cannot expect.
We should say, just to stop you there quickly, we should say
yeah.
you started the role in February 2020.
That's correct. Yeah.
Yeah. So right into the the headwind straight away. You were thrown in at the deep end. Yeah.
Yeah, correct. But also around that, specifically, if I take the case of coronavirus, because it dictates kind of everything else that has happened since then. You do not expect to have to become an expert in labor law in each of the countries where you're based overnight, but still that's something that you have to do, because Germany has taken some measures, the UK has taken some measures, France has taken some measures, and we're a pan-European company at the moment, so we have entities pretty much everywhere, and so you have to reconsider, for instance, your headcount and payroll by taking these into account. So you have to integrate that kind of knowledge really fast. And I didn't know that this was something that would be expected of me, but I'm glad, because it's just broadens your horizons, all while making you a more efficient CFO.
I just want to quickly pause to encourage everybody, if you have questions, to please ask them, because I have questions and I'll just keep asking them, but I think they'll be much better if they come from you. I will keep an eye on the chat, but if you really want to make sure that we see it, put them in the questions tab, which you'll see at the top. But either way, I'll keep an eye on the chat. I want to turn now to the first time I really sort of became aware of you and started following you was when you started writing Chasing Paper, which is your blog. If anybody hasn't read it, I highly, highly recommend it, because it's a really nice way of looking at the CFO role, kind of as exactly as you were, a first-time CFO with a lot of experience in business and entrepreneurship, and then applying that to to being CFO, as opposed to, I don't know what the other way around would be, but it felt very new and original to me. And you had a concept in one of the early pieces, which you called finance hacking.
Yeah.
I wonder if you could describe that to everybody.
Sure. So to elaborate a little bit on finance hacking, I think I was puzzled when I started this job and this new position, that there weren't that many tools that were available to CFOs to kind of quickly review information that they needed. And so if you see what's expected of a CFO today, is you have to be very strategic, but you also have to master data. You have to take care of many, many things within the organizations. And the tools that that are at your disposal to do that aren't that many. Of course, there are great off-the-shelf solutions tackling one aspect or another. Spendesk is a really great example on spending. Carta, for instance, on the cap table management. But the way these tools integrate with each other is either way too heavy for fledgling businesses. For instance, you won't be using an ERP if you're just a team of 5 people. That just doesn't make sense. But at the same time, if you start having this habit of using spreadsheets for everything, then at some point you might be facing a serious backlog and technical debt within your finance operations. So I believe that there's a third way, and this third way was inspired to me by something that exists in marketing, which is growth hacking. And growth hacking to marketers, it isn't a bag of magic tricks and recipes. It's just about building a growth system for the organization that works for this specific organization. So think about your funnel, about how you acquire customers, how you convert customers into fans, and how you mechanically make revenue from each of the customers in your funnel. That's how I think an efficient system is built, and I think many things could be applied to a position in finance, which basically is what I started doing. I figured, oh, I need people to do this, and having had a product background, being in an entrepreneurial onset, I just started using the tools that I was using before, just applied them to finance. So, oh, I need to do this automation. Well, I can do it myself with Zapier, and actually saved me an hour per day. So I just kept going and going until I reached a point where there's not much leeway for automation, but I've saved sometimes. And what I came to realize was that the job of a CFO is very cyclical. There are things that you have to do every month, every quarter, every year, and basically everything that falls into this cycle, I believe, will be menial, whereas the real value-add tasks will be the tasks that are one-off. You have to work on a merger. You're working with corporate development because you want to acquire a new target. You have to raise your next financing round. You have this mission that your sales are dropping, and you need to help your chief revenue officer increase the revenue, things like that. And the best possible way to have time to focus on these issues is to save time on the other kind of problems that you face. And that's, for me, by automating a lot of things. So that's what finance hacking is about.
You can read, we've put a couple of links to Chasing Paper in the chat, and you can read specifically about
Thank you very much.
use no worries. You can read about how you use Notion specifically, which I thought was pretty interesting, and Airtable. Those two. We have a question here from Luca, which I think is a good one, kind of related to what we're talking about, but more about skills rather than tools. So how did you scale up your hard tools in finance in a short time frame? And were any of them particularly difficult to learn?
That's an interesting question. I guess the first thing that I started doing is just realizing how much I was an ignorant about certain topics, and just realizing that directly puts you in a good position to learn, because I believe our brains are plastic, and once you're aware that there's this area or this zone of not knowledge that you want to learn about, as you go through your daily tasks, you start making connections, and your knowledge increases, and that's how you have a good learning curve. That being said, I didn't try to improve all of my hard skills at once, because that wouldn't make sense. I'm not in this position to be a student and to be a know-it-all or something like that. It's just the role of the CFO, especially during crisis time, is to cut through the noise and to focus on high-impact things. So I started having a roadmap of, we need to focus on cash management at the moment. So I'm going to start focusing on cash management. What's the best way we can manage the cash for this organization at this moment? How do I learn how to do that? And by going after the things that were needed and that were the most important at the moment, that's how my knowledge gradually expanded. And some things I've just left in the back of my mind. For some, they're still there. I know that I need to get involved with those. But I think the practice is how you learn, how you increase your hard skills. And another thing that I would recommend a lot of you can do is I started writing my thoughts on chasing paper, specifically because I knew that there was a lot that I didn't know about. And if I share my thoughts about a certain topic, then it forces me to think deeply about it and to gather thoughts up to a certain point where I have an opinion, at least, about it. And then this opinion can be challenged by peers, which it has. For instance, I wrote a piece on management control, and I've received 5-6 emails by other CFOs who said, oh, are you really sure? But can you really do that? Or have you tried this tool? And that's very helpful because it initiates conversations.
Cool. We have a couple of other interesting questions. I'll start with one from Anne-Marie. Have you already recruited people in your team? And if yes or no, what's your view on outsourcing versus internalizing certain finance tasks like accounting?
So I have really, really great people in my team that I'm thankful for. We're a team of 4. Legal and financial, because to us they have to be blended. Our job is to perform investments, so we have to write investment agreements, to proofread LLP agreements, to create ad hoc investment vehicles all the time. And so as part of our finance operations are legal operations as well. So we're a team of 4, and really, really helpful to have these people in my team. I guess internalizing versus outsourcing is a matter of where your value add is. To us, the core business is to, for instance, know precisely the valuation of our assets. And that's something that we're not willing to outsource, because we have to keep a tight leash, I would say, on this specific part of the business. Whereas, so that's a good example. Sometimes when one of our portfolio companies raises a round, we'll set up an SPV, special purpose vehicle, to invest as a minority investor in that round. So as a result, we have about 80 investment vehicles that we manage. Doing the accounting in-house for these vehicles makes absolutely no sense, because we would be in over our heads just doing that all the time. So we outsource it because we know that having a reliable provider that understands how it works adds much more value to our organization than doing it ourselves. So that's where I draw the line. It's for every task, basically, is it worth investing the time of the team for this one task, or is it better outsourcing it? And I guess that's also the way a CFO should look at everything that happens within the organization. You can, if your head of sales say, I don't know if I should hire 2 people to do this, or if we outsource it to this provider, and that's how I would at least approach the larger issue. Then, of course, look at the financials in detail.
We've got lots more questions, which are fantastic. I'm going to get to your questions in a second, Vladimir, but I think I'll just start with George's question because it's a little bit closer to where we are in the conversation. Since becoming CFO, what has been the biggest change you have implemented in the team or organization, and what has the impact been?
Processes. So the way this worked before I was a CFO was that there was basically a one-man band with someone as the head of the legal team. This is not criticizing at all, who would receive all the paperwork, store it in the cloud, also take care of how it's valued, etc., etc. And so it was very unprocessed, because whenever it's in the mind of a single person, there's no communication involved, which is both an asset, but also it's a drawback, because when the team starts growing and when people move, because they do, then it becomes much more complex. And again, I've taken inspiration from developers and from product people. For instance, one thing that I really like is that coders, whenever they write code, they are also spend time explaining what they've done to team members. So they comment on their code, and so by taking inspiration from that, we've started implementing processes where people within the team will review documentation. We'll have meetings to basically weekly meetings, just to know, okay, what's been going on, what progress have we made on this and that front. So processes probably are the biggest change that's been implemented. And I can see from where we were a year ago and where we are now, that it's saving us a lot of time and a lot of headaches. So it's a great thing, actually, to be implementing those processes.
Fantastic. All right, let's get to Vladimir's questions. There are 3 questions. The first one is, how do you use Airtable? If it will save time, I've put a link to your article on finance hacking that goes into it. Is that still basically up to date?
Basically, I've added more things into the way I use Airtable, but the general idea is the same.
Okay, so that's the answer to that one, Vladimir. Do you do KPI-driven projections? And if so, how do you integrate your sources to spreadsheets, etc., or Airtable, or whatever it is that you're using?
So I'd be very happy if I could do KPI-driven projections, because in our business, the main KPI is what we call net asset value, is the value that our assets in the portfolio are worth at a given time. And it's very hard. So we have about 250 assets in the portfolio. So 250 startup companies that we don't know whether they'll, for some of them we know, but the bulk, they're still in this quantum state where we don't know what they'll be worth when they exit, or if they are reaching close to an exit. So we can only know for sure what they're worth at the moment, and it's difficult enough job, I would say, to keep that up to date. So the way we do KPI-driven projections, I would say, is we use the gut feeling of the people directly in the front line with the entrepreneurs and with the portfolio companies. So basically, we will modelize a multiple on the investments. So let's say we have a company in our portfolio that's worth 10 million today. We will take the opinion of 3 directors in the company that work with this portfolio company on a regular basis, and one of them will say, I think it's going to 10x, and then another one will say, I think it's going to 50x, and another one will say, well, I think it's a write-off. Then we average weight their opinions, and we apply that onto what the future could be for this one asset, but it's very inaccurate by essence, because it's a gut feeling. But that's also the business that we're in. Early stage venture capital is hard. It's hard to predict. We just know that we need a lot of assets, and that we need to have steady ownership in those assets as much as we can to avoid dilution over time. And as long as we have that, then we're confident that if we're good at our job, which is making entrepreneurs build great companies, then we'll be successful in the end. And then the third question is
the third question: what controls and systems did you put in place in order to make sure everything gets done well, right, and on time?
What controls and systems did I put in place? So we built a tracking system that's just for our team, where basically two kind of sources of information meet. Is the inbound, and then it's not really outbound, but it's set in stone kind of. So for instance, I know that I have inbound posts for a given entity in the group that needs to be taken care of. But I also know that the end of the accounting year for another entity is coming next week. And so this kind of tool blends together the two sources, and it creates a kind of collective to-do list that allows us to say, okay, this has been taken care of. This was attributed to this team member. This is done. This is being done. This is in review, and now the case is closed. So it's still very manual, but it works for us because we're a team of 4. We talk a lot, and at the stage where we're at, we don't need that many checks and balances. That would be too strong on our own organization. But getting back to what I was saying around finance hacking, I think you have to build things that make sense for your size, organization, desired speed, and desired outcome. And for us, this is what made sense at the time.
Please do keep your questions coming, everybody. Those were great. I have another question, which was that you, in one of your articles, also mentioned the concept of the augmented CFO. Do you remember writing that?
I do remember writing that, yes.
Could you explain that concept to us?
What I call an augmented CFO is a CFO that kind of like leverages the power of automation, that leverages the power of software tools to help his organization, his team, and himself be better at reining in finance operations. And I think it has many positive outcomes. It has positive outcomes on obviously the speed at which operations are taken care of, which is a good thing. It has a positive outcome on the impact, overall impact of the CFO, because that CFO would be able to take care more steadily of the one-off events that need his full attention, and that's when he can become strategic rather than being caught up in processes. And that also has a great impact on mental health. I think it's worth noting in times of crisis. Very often, CFOs, or at least the ones I've had a chance to talk to, they can feel lonely within their team. They do not always have the best role, in terms of how it's seen internally. And because of that, taking advantage of tools and automation to become the augmented CFO allows to rest and to feel also more empowered in the job. And so that gives time to do a little bit of content, talk more with the other people in the team, and also, if you're part of a tech organization, then you feel also tech empowered, and that's a great thing to have in the organization. So I think it has many positive outcomes.
When you say it's not always the best role, sort of the way you put it, do you mean because you can end up feeling like the bad cop?
Yeah, true. That's what I mean. Also, I'm a bit over simplistic in the way I analyze this, but the years 2010s were not so great for CFOs because the startup world took off really fast, and there were mottos that went around coming from Silicon Valley, but also in other ecosystems. Grow fast, revenue doesn't matter. Let's delay profitability and focus on growth. And so all of the financial metrics were kind of overlooked. And so the role of CFOs naturally was overlooked as well. And I think this is in part what led to terrible things like the WeWork story or others that you've seen in the press. And I think the 2020s will see a spotlight shed on CFOs and on their role, and on the fact that they are actually here to help the company grow to profitability and to grow into a massive organization, which is the end goal for a startup. And so I think the crisis to that respect has been helpful predominantly. But it showed that CFOs were the second person in the company that was here along with the CEO to take decisions that will help the company move forward and to reach a position where it can become sustainable. And I think that's a great thing. So that's what I meant.
We had an article on CFO Connect from Leslie Boudreau, I think was her last name, all about she's in recruiting for CFOs, and all about the focus that companies had, exactly as you said, during the 2010s, maybe slightly before, where suddenly it was not so much about financial background, financial knowledge, risk management. It was much more about bringing in CFOs to basically grow at all costs. And she said one of the things, exactly as you've just said as well, one of the things that the crisis kind of helped to maybe rectify slightly, depending on your point of view, was a bit more focus on the basics again, and actually bringing in CFOs with experience in doing things in a sound and sustainable and profitable way, and not only worrying about growth at all costs.
That's true. I think one of the conclusions in the articles in Chasing Paper is that the 2020s will not put everything in question. Obviously, growth is important, especially for startups, and reaching sustainable growth is an important goal and strategic for startup companies. But I guess the way VCs think and the way private equity companies think, so thinking about cash conversion, EBITDA, cash cycles, much earlier will all come together. And actually, I think we're seeing a lot of big PE companies investing in late stage, fast growing startups these days. And this is materialization of that kind of it's true that we can have companies that are growing fast, but that are also sustainable and stable in terms of finance. And having CFOs is really the way to go about that, or having CFOs join to take care of this.
And speaking of bringing on CFOs, it's one of our absolute favorite questions, this time from Sebastian. When, from your work as a kind of VC or as an incubator, when is the right time, do you think, to hire a full-time CFO? Or what are the indicators?
The one condition is to have money in the bank, because it's very difficult to manage finances that do not exist. I'm kidding. But really, after an important financing round, so either A or B round, is definitely when you at least need to have one person in the organization focused on that. Then I've seen many things happen. What happens very often, at least with the companies that we work with, is that from the seed round there will be a financial manager that takes care of everything from accounting, spending, reconciliation, bank transactions, etc., because it's just some weight off the shoulders of usually the CEO. And then later on, as the strategic importance of having a CFO grows, for instance, we have data about the business and how it's moving forward, but we need to translate that into reporting material for our investors. Plus, we need to take strategic decisions based on the sales forecasts, etc. That's when it becomes important, and usually the tipping point is around Series A or Series B. And then what we also see is that it's changing role. Sometimes a person that could be a good fit at Series A will have to move forward at Series C, because then you'll have different kinds of conversations with different kinds of investors and different kinds of issues that will require the CFO to change. Pretty much like the job of the CEO, it's difficult to grow into the role, especially if it's the first time. So I'm well aware of that. I try and keep learning, but I would understand that at some point it's time to perhaps pass the baton over to someone who's more experienced. And it's not a problem per se, because then you can either do it again with another venture, or keep learning with the same person, and then when you'll be exposed to the same kind of issues, then it will be much easier to take care of.
Well, and on that idea of personal growth, Pierre-Louis is asking what your top 3 technical skills are that you think are required to be a CFO. Not necessarily a finance-oriented skills, I guess, is what he's saying.
That's a good question. I would say to be very thorough is important. Not because everything has to. So you have to know how to take decisions, and being thorough is not incompatible with that, but you have to know when to apply which of the two. I'm a fan of the Pareto law. It basically says 20% of the effort you apply will yield 80% of the results. And I think it's a good thing for CFOs to be able to make radical decisions and say, we'll focus on this, and that, this will yield results, and the rest we'll see later. But once you're going into one path or you've made one decision and then you need to apply and execute, being thorough is paramount, because leaving something aside or forgetting something can prove dreadful down the line, and the best way to avoid that in the first place is to get this in this habit of being thorough. But that just relates back to the question we had about how do you keep track and make sure that everything's taken care of on time. It's a matter of getting this habit, but it's also, I think, a personal trait that's important. So being thorough, being radical, and knowing how to take decisions, and then being analytical, I think, is the third, I would say. Not only in terms of how good you are at financial analysis, but in terms of how glad you are to think about business decisions and business models and business in general, because you have to be willing to get up in the morning and say, how come that these customers aren't paying as much as these ones, and we have the data, but I still cannot figure it out, and then go and talk to the team, customer support, or talk to marketing, or talk to people involved directly with the customers to understand these kind of things, and just willing to be asking a lot of questions and then pull out the data to run the analysis is I think another important skills. So I'd give those three. There are many others, but to me they are the most important.
I actually think on that last point as well, that's one of the real big value adds of a CFO or of a finance team in general to the rest of the company. Obviously, I'm in marketing, and having someone coming from outside the team and just asking pretty simple questions like, you're spending 2 days on this project, what is the expected outcome? Or we did this thing and it worked really well, why aren't we doing it again? Those kind of what is probably relatively simple from your perspective, that kind of analysis and bringing it to the other teams is so valuable. Even it's not always easy to hear, I'll admit, as the marketing person, because I think every project I'm doing is worth doing. But sometimes, hearing it from the outside is really valuable.
That's true, but I think if you have a sensible approach to it, then it makes sense. And then the second thing is that another really important thing that's increasingly important for CFOs is to be able to pull out all this data really fast, and becoming the augmented CFO that I was talking about really helps with that respect, because whenever I have a question about, okay, what was going on last month, and I know that I have my own dashboard where I can go into, and that it's categorized the way I want it for me to understand things about the business. And whenever it's not relevant anymore, then it's flexible enough that I can switch and change perspectives and points of view. And that's why I think knowing a little bit of code or knowing how to use product and tools to your own advantage is important, because then you can ask the right questions, and then you can go to the relevant people in the team and say exactly what you just mentioned, that are really relevant things for the organization.
Okay, we have time, I think, for one more question, and that's great because it's a complete change of topic, I think, but it's a fascinating question. So hopefully you'll have some great insight here. It's from Mehdi. Looking at financial markets currently and how indexes like the S&P 500 keep soaring, do you believe there's still such a thing as a link between price and intrinsic value? Or are we now in a world where price is just defined by how much you're ready to pay? What does it look like in the private startup market in France?
Really interesting question. So about the public market things, my colleague Balthazar de la Vergne has published a piece very recently about growth stocks. I don't remember exactly the title of the piece, but I'll share the link afterwards. Make sure that that's sent to you. And basically his thesis was kind of interesting, is that we can have these days stocks that are public and that have IPO'd at a very high price. So it's not correlated to the actual financial metrics of the company, and we agree on that. The price earning ratio is through the roof. But what's interesting is that those are companies with high speed growth and that can realize their financial metric potential actually in the next 5 to 10 years. So the question is, if you're looking at Spotify, or if you're looking at Shopify, if you're looking at Zoom, these kinds of companies, of course, they have high prices, but the underlying question is, do they have a sustainable growth system that will help them grow into their valuation? And for some, I think it's the case. For instance, Stripe is the biggest valuation on private markets at the moment. It will IPO probably with a crazy price tag, but I'm sure that it's a company that will 5 or 10x over the next 15, 20 years because of the growth potential it still has. So that's the way I look at it. Now, in the private startup markets, and in terms of valuations, I think investors are really driven by their fear of missing out, and that's in the best deals, it creates diffractions in the valuation. So obviously the valuations are really high, but the reason is because everyone wants to get into the same deal, and so that's what drives the prices up. So in this case, it's defined by willingness to pay. But again, same question is, are you trying to get into a company that has high growth value and that will realize its potential over time? Or are you just trying to get into a company that will fall back like a souffle at some point? And it's not really possible to know that for sure, but that's what's exciting about about our business, or at least what I find exciting about it is that you can bend the future of the company by working with the entrepreneurs and help them fall into the category of high growth companies.
And is that sort of analysis that you just did, is that the same in France as it is in Silicon Valley? Obviously, it's a matter of scale. Essentially the same thing going on though?
Yeah, I think it's essentially the same thing. For a long time, it wasn't the case, just because there wasn't enough capital available to startups in France like there was in Silicon Valley. I think what's great about Silicon Valley is that it's a high velocity ecosystem. So everything happens fast, meetings are fast, investments decisions are taken fast. Introductions are made faster. Clients want to sign up to your beta. So it just happens really fast, and we have to take more time over here in Europe. But we're getting to the same kind of paradigm. Perhaps one thing that we're lacking is the kind of like middle ground capital availability. So it's really difficult to raise from European investors tickets ranging from 50 to a couple of $100 million, just because there aren't that many actors in Europe who are able to sign those kind of checks. But investors from everywhere are really willing to fund our European companies, so we're glad about that. And so it just creates the same kind of urgency and the same kind of dynamic pretty much everywhere. And that's one reason why us as the family went from being a European Europe-centered organization to a global one now. So we are ready to serve entrepreneurs from all around the globe, because the same dynamic will apply, at least to the ones who are willing to build high growth companies.
Fantastic. Those are all the questions, and we've just hit exactly an hour, which is what I promised you. Exactly an hour since I hit start 4 minutes late. So again, apologies for that. I want to thank one more time Younès for his time. I was really, really interested in all of that. I hope it was a great sort of experience and a great, good entertainment for everybody who joined us today. Of course, there will be more, so please keep an eye out for the next CFO Connect event. Keep an eye out for the podcast. Fingers crossed everything goes well there. And otherwise, we'll see you all next time.
All right. Thank you, Patrick. Thank you, everyone. It was great being here.
Thanks very much, Younès.
Bye.